So let's bring our guest on.
Yes.
JC.
What's up, gentlemen?
Let me just clap it up for you one time.
Yes. My brother, how are you?
I'm well. Thank you, guys. Thank you
for being here.
How you feeling, man?
Listen, it's the world can be a messy place, but when you take a step back and you zoom out and you appreciate, all of the progress that is made slowly, might not be on the front page of the news, but it's small little wins for society that kind of go unnoticed. But who is noticing is investors. S&P, NASDAQ, Dow, new all-time highs. Europe, new all-time highs.
Yep.
You know what I'm saying? So, and pessimism still rules. You look at consumer sentiment and, we're at some of the most pessimistic levels of all time.
Yeah.
Stock markets at all-time highs. Sell-side strategists, Wall Street, super bearish, super pessimistic. That's a great combination of people being worried that things are bad, but then things are actually, they've never been better. That's a great combination. It's when everybody thinks that everything's so great, that's when the problems start. But we're just not there. I mean, you guys tell me if I'm wrong.
Well, yeah. So I wanted to, first and foremost, thank you for coming back. Appreciate it. JC, he did a marvelous job last time he was here. So I want to start out with, I know you're a charts guy. So based on the charts that you're reading, now you look at things, how do you see 2024 playing out? A lot of people said, obviously we had a great year in 2023. There's some people that's nervous. The political cycle, it would say that it would be a good year based off of past history, based on an election year. So where do you see this market right now as far as charts is concerned?
I like how you throw out the seasonality there. No big deal. No big deal. It's a little 4-year cycle. Throw out a shot out there. I like it. No, listen, it's less about the charts and more about reality, right? A lot of people are like, oh, the market should do this, or oh, the market could do this. What is it actually doing, right? That's what I'm mostly interested in. What is actually happening? And it just so happens that the best way to visualize what's actually taking place in the market is in a chart, right? You could literally see it. And I'm not like the smartest guy. Like, you could tell me something a million times. You got to show me. Like, let me see. Like, can I just see? So the charts are very helpful to be able to see what the market is actually doing. Is the world falling apart? I don't know. Let's see what the S&P 500 is doing. Oh, I see it at all-time highs. So I don't know. Maybe the world is not actually falling apart. Maybe things are pretty good. Oh, maybe it's just the United States that's doing so well. Why don't we look and see what's going on in other countries? Oh, shit. Brazil's making new all-time highs. So Chile and Peru. And
the Nikkei.
Nikkei 33-year highs. Germany new all-time highs. All Denmark does is go straight up with their healthcare. It's fantastic. France, new all-time highs, ton of industrials there. You look at Asia, things like Jakarta, right? Like, the only thing not working is China, right? Which is a very rare exception. I mean, you go down to Australia, things are good. So just more new all-time highs across the board. You see an expansion of stocks making new highs, right? We had over 50% of the S&P 500 was hitting new 3-month highs the other day. Like, those are the types of things that happen early in cycles. So in terms of what are the charts telling me? Like, for the year, well, I don't know what's going to happen a year from now, but we're not in a market environment where things are getting worse. For the last 18 months, we've been in a market environment where things keep getting better. So you're going to see things stop getting better before they start to get worse, right? Like, we're not getting, you know what I'm saying? Like, things aren't getting worse. They just keep getting better. So when that stops, then we'll have a different conversation. So that's how I see it. So what does that mean? Oh, it's a bull market. It's a bear market. Like, why should we care what kind of market environment we're in? Because that's the first thing that we want to do as investors. First, identify what type of market environment we're in, and then decide the best tools and strategies for that environment. Right? So if we're in a low volatility environment, why on earth would you incorporate strategies that are good for high volatility environments? That would be stupid, right? That would be dumb. That just doesn't make mathematical sense. So we're in a low volatility environment. Let's incorporate strategies that are good for low vol environments. Okay. Are the majority of stocks going up or the majority of stocks going down? I don't know if you've looked, but the majority of stocks have been going up. So we want to spend our time. Yeah, we want to spend our time looking for stocks to buy versus allocating more time looking for stocks to sell. You know, there are more uptrends than there are range-bound markets. So we don't necessarily want to incorporate too many range-bound market strategies. We want to incorporate more trend-following strategies, right? So that's how we look at the current state of the market, how we want to approach it. I think it's like that.
When we look at 2024, we've already heard that there was going to be rate cuts, and so we're big on technology. We talk about technology companies all the time. We see companies going up and up. With the rates getting lower, obviously that would create an environment for tech companies to continue to appreciate. What are your thoughts on that? Because everybody keeps talking about this pullback, this recessionary environment in the second half of the year. They said that in 2023. We didn't see it. We spoke to you about it, and the charts didn't indicate that. What are your thoughts around the tech sector with interest rates being reduced over the next 6 months?
Yeah, you know, stocks and bonds are moving together. That's the big thing. And if you look at technology, technology represents almost 30%. Basically, today it's essentially pennies from 30% of the entire S&P 500. This is technology. So if we know that stocks and bonds are trading together, right, then your thesis that lower rates should be good for technology stocks, I would agree with all of that, right? That would make perfect sense. You know, what I think actually is getting, you know, taking that one step further, I think part of the driver of that trend that you're talking about is the fact that a lot of investors still think that the treasury bond market is the safe haven. Like when stocks sell off, bonds rally, that inverse correlation that we had in place for a long, long time, the majority of my career, certainly. But we're not in that type of environment. We're in an environment that's more inflationary, where stocks and bonds are trading together, something like maybe the 1970s. So we're just in a different kind of environment where stocks and bonds need to be treated differently than most of us have been accustomed to over the last 20 years. So that's just something to keep in mind. And I think it's taking investors a long time to come to terms with that. And I think that is further unwind of just how critical I think, you know, rates staying down could be good for the stock market and technology in particular, as 30% of the S&P.
What stocks or sectors surprised you the most in 2023 and how much they went up?
Well, I mean, I didn't see a 50 spot on the Qs, I'll tell you that much. You know, I mean, you know, we were bullish, we were buying stocks, we were buying them, you know, because if you recall, kind of like rewind for just a second. So back in the late 20s, in late 22, the short interest in these tech stocks was off the charts, right?
Yeah, it was high.
We had a bear market. The majority of stocks bottomed out in June of 2022, right? That's when most stocks stopped going down, and then from there things got better. But some of the tech stocks and Qs continued to fall, even though most things were already on their way up in the back half of 22. The bears, the short sellers, instead of covering their shorts after these massive declines, like 80-90% decline in some of these growth stocks, right? You guys know.
Yeah.
Rather than covering their shorts, some did. We were short some stocks. We covered our shorts, right? Some people did. But in aggregate, which is what counts, not only did they not cover their shorts, they added to their shorts so that by the end of 22, they were the most short those growth stocks the entire cycle after most stocks had already bottomed. So that's that unwind. And then Wall Street comes in with their first negative expectations for the S&P 500 on a consensus basis, negative year, first time all century. At the same time that all these institutions were super short, you got that nasty squeeze. So what surprised me, I didn't see, as bullish as we were, I didn't see a 50 spot on the Qs. But what I will say that I'm not surprised, but I think is going unnoticed, is that the best performer in the second half of last year was financials. Nobody's talking about that. Remember banking crisis?
Yeah.
3 banks no one's ever heard of disappeared. So what? More of them should have gone. There's too many as it is.